Welcome. My name is Sasha Moore, and we're here today at the How to Minimise Tax this financial year live panel event. The aim of this session is to provide valuable insights to both brokers and SME clients from the lens of an award-winning accountant and a specialist private lender of what to be aware of and where the breaks are. So today we'll be covering superannuation changes and updates and how this is also impacting SMSF lending, tax changes and implications, some strategies of how to minimise tax, which I'm sure you're all very keen to learn more about, business write-offs to have on your radar, how business loans can be tax efficient, where private lending can fit in strategically. So let me introduce you to our esteemed panel. We have Davey Mack from Box Advisory Services. Welcome, Davey.
Hey, thanks for having me, guys. Excited to be here.
Good to be working with you again. This isn't our first rodeo. It's very common knowledge. I think Davey's a complete gun in the accounting world, and it's always tremendous to have his insights. So good to be working with you again.
Thanks, Sasha.
And we have Matthew Porch, who is the head of distribution at Aquamore. Welcome, Matt.
Hi, Sash. Hi, Davey.
Hello.
So what we're hoping to achieve with this panel is Davey will very much be giving the insights from an accounting perspective, and then Matt will be providing some commentary of how that then sort of fits into the lending landscape, and particularly as it relates to private lending. So superannuation is always a hot topic. So Davey, let's start with you. I'd like to get a bit of an understanding of what the ATO's position is and what changes and updates should brokers and businesses be aware of as it relates to super.
Yeah, sounds great. Well, firstly, what's not happening with superannuation funds? There's a big change, and the biggest change that we currently are seeing with the government is that the government is trying to impose a new tax rate on super balances that are over $3 million. And initially, it's either 0% if you're in pension phase for a super fund, or 15%, which is a flat tax rate. However, now that this is changing, and that change is going to take effect on the 1st of July 2025, which means that any super funds and members that have a balance over $3 million, in these days, it's not that hard to get if you have a property in a super fund or self-managed super fund. The money or the income that's earned over $3 million will then get imposed a 30% tax. And this is known as the Division 296 tax, which is not legislated yet, but will be legislated soon with the government. And the good thing, though, the only good thing about this is that they're planning to index this, which means that they accounting for inflation. So if inflation goes up, then they will increase the threshold of 3 million to possibly 3.1 or 3.3 over time. So that's the only good thing about this, but this is actually a very bad situation for super funds and SMSFs, because then you could be paying a higher tax rate than in your personal name. And then you got to start thinking about your investments in super, which now might cause an issue where people are not going to invest in super as much as what they're usually looking to do. For example, the tax cuts that are in place right now, the stage 3 tax cuts for 2025 has now reduced the tax rate from being 32.5% to 30%. So you pretty much can earn up to 135K at a 30% tax bracket. So why do you need to start putting more money into super and investing in super when you're paying the same tax rate? And it's going to be imposed on you if you push into super, which you can't really touch. So that's something that's changing, and it's going to cause waves in the superannuation world. However, it only starts on the 1st of July 2025, and it's not legislated yet. So it's something that everyone needs to keep note of, advise their clients, get them to speak to a financial planner or accountant to, start working out their strategy for super moving forward. Another change that is quite big is super payments for your employees are getting paid on a quarterly basis at minimum. Now, the ATO on the 1st of July 2026 wants it paid, and on the same day the pay is getting paid. So if you've got weekly, fortnightly, or monthly pay runs. They want superannuation to be deducted on that same day. Doesn't sound like a big deal, but it is, because a lot of employers and small businesses use their cash flow and manage their cash flow, and they used to paying on a quarterly basis. Now they're going to have to pay the money straight away once the pay run is being implemented, which then causes a lot more admin work in the short run and cash flow issues in the short run, but should help you in the long run with admin work and cash flow, because you know that the money that's in your bank account is all yours now moving forward. The last change, I think, is the superannuation compulsory rate is going from 11.5%, to 11.5%. And next year, it's going to push to 12%. They're the major changes that are currently happening with super.
They're pretty substantial changes. And I also would imagine that there's not widespread knowledge of this. And I know, just from my personal perspective, one of the reasons I love working in financial services is you sort of just get this heads up of what is actually happening. Matt, the brokers that you've been working with, in terms of then the types of properties that you're structuring, commercial properties that you're structuring through Aquamore, how are they going to be directly affected in terms of their strategy potentially with this new tax situation?
It's hard to say. I mean, everybody's got their own tax strategy. Everybody's got their own way of doing things. Personally, and again, it's not to be construed as financial advice, but I think investing in a commercial property as a small business owner is a fantastic strategy. Why pay someone else's rent when you can fund your own retirement and look to liquidate that asset later down the track for capital gains and all the rest of it. But I think Davey made a really good point around the pay cycles and superannuation changing. We obviously analyse a lot of financials on a daily basis, and you do see set aside money for superannuation or unpaid superannuation, for example, and a lot of employers and small businesses forget the fact that super is due in a quarter or a half year's time, and they just bank on the fact that they're going to cash flow that later on. So I think that change will be significant for small businesses where their cash flow will be strained, and they will have to look at funding superannuation as soon as it's due.
No, indeed. Well, Matt, staying with you, what changes have you noticed on the SMSF lending landscape? Because I know that strategies we're talking about, small business owners looking to then purchase commercial property as part of their strategy. How's that evolved over the last year or so?
Yeah, I mean, obviously the major lenders have taken a step away from superannuation lending, as everybody on this webinar will probably be aware. And I think the reason is not so much increased legislation. I think it's just the legislation changes year by year by year, and the banks maybe see it as too much of a headache. But we are seeing an increase in SMSF lending criteria come through. There are an increased demand for people looking to save into their SMSF, but again, my advice would be to speak with a qualified financial planner and someone who knows what they're doing. I think that ties into the last webinar we had with the guys from Aquila. It's really important you get this stuff right, and it's really important you understand the basics of the SIS Act so that you're compliant with what you're looking to purchase.
No, indeed. And I think you raise a really interesting point. I think from a general consumer perspective, investing in an SMSF seems really straightforward and a great option, and it's tax effective and all of those things. But it's one of those it can become one of those very complex situations very quickly if not all of your ducks are lined up in a row, and that it's done sequentially. And just to also just go back to that webinar, Matt, that you were talking about just now with Aquila, one thing I did want to very much also just take from that and reiterate is, as a broker, if somebody wants to come and invest in an SMSF, and Davey, feel free to chime in at any point, the number one question I would ask is your SMSF set up? Because and this is also from my own experience of this, you find a property, you're like, okay, great, I'm going to purchase the property. It's in a really time-sensitive environment. And then I just thought setting up an SMSF was like setting up a bank account, but it's not. It's far more detailed than that. So what I would really urge brokers to do is the second that you hear an SMSF conversation, just get your ducks in a row. And one thing that I'll also share off the back of this webinar is we've just compiled a really good summary sheet for SMSFs, for both brokers' information, but also so you can give through to your clients. So you are in a position that you can facilitate a deal. David, did you have any additional thoughts?
Yeah, it takes about 4 to 6 weeks for us to help the client to set up SMSF. And that's because there's a lot of documents that need to be produced. Client needs to go and sign the documents. It comes to us and it goes back to them. And then after that, there is usually a trust, a custodian trust that you need to create, or which is also known as a bear trust. And then after that, then you create the bank account. But there's no money in the bank account, then you got to do a rollover contribution. Then that takes time as well. And then by that time, the settlement date might need to be pushed back as a result. And it happens so many times. And usually it's so frantic when it comes to in our accounting world, when the client freaks out, they're going to lose their 10% deposit or whatever deposit they
right.
So something that you need to be sure of, and by having a good qualified financial planner, a good qualified accountant, people in your team that you can just refer to ensure that the job will get done properly. So the client doesn't call you and freak out. That's the perfect opportunity for you.
Yeah, and one thing I'd also just caution, and again, having almost fallen into this trap personally, is very easy to think as a consumer, oh, well, you know what, it's fine. I'll purchase the property in my name and then I'll switch it over to the SMSF. And that, again, just in my own personal experience, that is a nightmare. That cannot happen. Or if it does happen, it is beyond difficult from a red tape perspective. So again, I'd very much caution the brokers here, just the logic that you think would be very simple and straightforward with SMSF does not exist. And that's why I really say, unless you have your ducks in a row and unless you understand the parameters of that SMS requirement, your client can end up in hot water very, very quickly. Davey, have you seen that happen at all?
Yeah, it happens quite often. And then pretty much the broker loses, the client loses trust in the broker, and then you've basically lost the client for life. And that's the problem. Like and that's because you're relying heavily, not just on your expertise and your skills, you're relying heavily on the accountant, the financial planner, the lawyer to ensure that everything gets done. And so you got to be very careful with the people that you work with. And you got to be careful of the advice that you give to your clients. So it's really important to be sure that you know what you're doing when it comes to SMSFs. And it's also a good thing to kind of set it up earlier. If the client is looking at doing this, so you just know for sure that everything's ready, so you can shorten the time it takes to get this done. And yeah, exactly, Sasha, moving from selling a asset in your name and then moving it over into the SMSF, you're paying double stamp duty.
Yeah,
it's not worth it.
Yeah. So we've actually had a few questions come in about this topic. So Matt, want to direct you from Senior. What's the LVR or maximum loan amount for an SMSF loan? So I know you can't obviously comment from a general perspective, but as it relates to Aquamore. Oh, I think we have a computer freeze.
Yes.
Okay, we might come back to that. Alan's come through and asked what guidance that we can provide on marketing SMSFs to prospective customers. So Alan, as I mentioned just a second ago, we will provide some assets which are really handy for both brokers as well as clients. But to Davey's point, one thing I want to really stress about this is the advice piece. Brokers cannot be seen as providing advice about SMSF. It has to go to an accountant or a financial planner. So really look at SMSF as a product. If the customer says to you, I want to do this, that is one scenario, opposed to what do you think about this? So the what do you think about this would go to an accountant or a planner, opposed to you. Davey, would you concur?
Yeah, same. Like we have to be careful of advising our clients too. We can't advise them on buying an asset in an SMSF or setting up an SMSF. If the client says to us that, look, Davey, I want some advice in terms of the structuring, or I'm planning to invest with my SMSF, and then that's okay with us. If they haven't said anything, they want some advice, we have to refer them over to a financial planner. And it's good to kind of have a financial planner on the side that you can just go, hey, have a chat to this client. It won't take too much of your time, but then as a result, you could get a client for, insurances and, further advice, and you can make some money on that. So that's why, like I said, from the very start, get a good team of advisors. And so therefore you can just refer to them and not have that problem of needing to, by accident, giving financial advice. Yeah.
Yeah. Okay, so Matt, I have.
Sorry, yeah, on you go.
No, all good.
The connection dropped out there. Yeah, start again.
Yeah, all good. So we've had a question come in from Sinya about the LVR, or maximum loan amount for an SMSF loan. So obviously you can't comment to all of market, but for Aquamore, can you provide some insight?
Yeah, absolutely. So maximum loan size is $7.5 million. LVR is all dependent on the property type. The majority of it comes down to the property type. There then will be some further considerations about serviceability and exit strategy and all that sort of stuff, and lease agreements. But like the average LVR on an SMSF product, somewhere around about 65%.
Great, thank you. We've had a question come in from Juan. This is for you, Davey. What are the rules on stamp duty with property in an SMSF and corresponding tax minimisation?
So there's no discount with stamp duty. You still have to pay the stamp duty when you're transferring a property or purchasing a property in SMSF. There is a concession if you're selling a property that you own personally over to a SMSF. So, however, you got to be careful that if, for example, you own a property yourself, and let's just say that you're in a relationship and you've set up SMSF, and that SMSF has two members, which is you and your partner, then that causes a problem because you're not selling to a SMSF that you are the only member. And that's where stamp duty can exist, and you probably have to pay stamp duty on that. It's still sometimes beneficial by doing that, because the great thing about having an SMSF is that you could get a 0% tax rate if you're in pension phase over 60, or a 15% tax bracket, which is still good compared to a 45% or 47% tax bracket in your personal name. So sometimes when you, in the long run, it's actually better just to move the asset into a SMSF, because you get that better tax rate. Obviously, you got to be careful with that 3 million rule that may or may not come into practice, but when it does, we can worry about it then.
Yeah, and I think it just really reiterates that, and I think you made a good point, Davey, in terms of having people in your corner. So what I would really take from that is any client who's looking to do this is that you really reinforce the value of having an accountant and a planner set this all up before you're then on the scene to then facilitate the acquisition.
Yeah. Oh, so, one last thing, just to point out, sorry. When I said the concessions, that's to do with New South Wales. Stamp duty is a state tax. So you got to be careful which state you're talking about, and where the property lies. Yeah, so don't mix that up. Best to speak to an accountant or a tax lawyer when it comes to stamp duty.
Thank you. We've had a question come in from Tyler, who's saying that they're looking to buy an office for their company. What would be the best vehicle, company, trust, SMSF, to do this, and why?
Great. I can jump in and answer this question. I actually own the current property in that I'm sitting in right now, and obviously it really depends on your situation. So obviously I look 18. I'm not 18. I'm 34 years old. I still don't have enough money in my SMSF or super fund to be able to afford to buy a commercial property in my super fund. And so I've decided that because I can't do that right now, it's best for me to own it in a unit trust or in my personal name for the time being and charge myself rent. And the reason why I prefer to do it in a unit trust in this case, because it just segregates the asset away from my personal name, because I could get sued, because obviously I'm providing advice. They can sue me personally. and as a result, I don't want my office to go with it if something were to happen. And so that's more asset protection. In terms of minimizing tax, because it's in a trust, I could possibly distribute the profits over elsewhere, but in my sense, I've actually set it up in a unit trust. And the main reason why I've set it up in a unit trust is because I want to avoid and minimize my land tax. And if you have it in a family trust in New South Wales, you lose the land tax free threshold, and that could mean that you're paying $16,000 a year on land tax if you have it in a family trust. And so it's very hard for me to answer this question without applying your situation. But if your situation is very similar to me, I'm young, I don't have enough in the super funds. My plan is one day to move it into a SMSF because the SMSF has a tax rate of 15%, whereas my tax rate is 45% and my business is 25%. I think it's the best move to move into a SMSF. The great thing about that is also if you ever sell the property one day, it could be taxed at 10% because of capital gains. And that's the best option for most people in terms of structuring their business, structuring their office and purchasing their office.
Thanks, Davey. One thing I will say to everyone as well is we'll provide both Davey and Matt's details in the follow-up email from this webinar. So if you do have any specific questions, you can feel free to reach out to them and their team. But let's keep moving on. So Davey, staying with you, what tax changes should businesses be aware of at the moment?
Sure. So in terms of business tax changes for businesses, that meme where the weed just rolls over in a desert? That's basically what I see the federal budget, a few months ago. There's actually not many changes apart from the lower tax rates and lower brackets. But that was around for the last 6 months. So you must be living under a rock if you didn't know about those. But obviously, if I'll just explain for the people who don't know, basically the 32.5% tax bracket's reduced to 30%. And the bracket was initially up to 120K. Now it's going to 135K. So you can actually make a bit more money and pay less tax. Same goes with the 180K tax bracket. It's going to 190K, but it's still 37% tax on that. So what does that mean? Most individuals and employees will get more money in their take-home pay. That's what that means. I had a client actually call me up and go, "Hey, did you change my pay rate and give everyone a pay rise for the employees?" I was like, "No, you're paying them more because there's less tax and they get more take-home pay. Nothing's changed. The wages still stay the same, but they're getting more money and you're paying less taxes in the tax withholding." That should, as a result, I hope, I'm not a broker, but I think that would affect the borrowing power and it should increase because there's more disposable income. So that the main thing, that's the biggest change. What hasn't changed and what's still going to continue is the $20,000 instant asset write-off. That's finally been legislated, and that's going to extend all the way to the 30th of June 2025. So you got one more year of that, but just understand that you're just getting an asset write-off, instant asset write-off on a expense that you're paid for that's under $20,000. Back then, it was like 150K, and during COVID, there was no limit. You could spend as much as you want on an asset and write the whole thing off. So the $20,000 isn't that big of a change. Apart from that, there's no real. Oh, there is one small change or massive change from the government is that you're getting a $325 energy relief rebate. That's the only thing I know. Yeah.
Yeah, we'll leave our thoughts about that on the side.
For all businesses, $325
Yeah.
relief rebate. Apparently, that's helpful for businesses.
Yes, indeed. Well, just to go back to what you were talking about before in terms of optimal income to minimize tax. I'm actually really interested in this in terms of that golden amount to earn to have the most effective tax rate. So, David, can you talk us through that amount and then how that may be structured?
Yep, I work with quite a fair bit of brokers. Probably about 5 to 10% of our clients are brokers. And the great thing about them is that they usually want to minimize as much tax as possible. And so when they ask me, how much should I pay myself to ensure that I pay as minimal tax as possible so I can increase my borrowing capacity, what I usually give them is that 120K mark. So back then, in the financial year of 2024, $120,000 would keep you within that tax bracket of 32.5%. However, you're not paying 32.5%. Your effective tax rate was 25%. So if you went into paycalculator.com.au, slapped in 120K, you're paying about 25, 26%. That is a similar tax bracket as you leaving the money in your small business that's taxed at 25% in the company. So I usually try to keep it within 25%. Obviously, you can put it into the super fund and then you get taxed at 15%. However, you lose that disposable income. You can't use it to invest. You can't, and that's where it causes a bit of issues. So that's why we always advise our clients that it's around 120K. However, 120K may not be enough for everyone because the disposable income after taxes will be about like what, $90,000. Some people and people living in Sydney may not be able to afford to live off just a disposable income of $80,000 to $90,000. So therefore, we can bump that amount up to 180K. However, because of these new tax cuts that came in, that 120K has now bumped up to about, I would say, around $130,000 to 135K, because now the tax rate is 30%, but the effective tax rate would then be 25% at 130K. So that's a lot of numbers. Hopefully, I'm not confusing you guys.
But so I guess just and tell me if this is correct, just to summarize. So I guess if you or your client are in the privileged position that you're earning over 130K, rather than say you're earning 180K, you want to try, in terms of minimizing tax, you want to try and see if you can live off 130K and divest, say, that 50K into super or whatever it is. So then you're minimizing tax all around.
Yep, that's nicely put, basically. Okay. I should have just said that. But yes, you can either put it into super, the leftover profit, or leave it in the company at 25% tax.
Okay, fantastic. It's what happens when the marketer is chatting with the accountant. It's like the interpretation.
Halfway into it, I just realized, oh my God, I'm just talking too much numbers just there. But hopefully, Sasha, great to have you here. So you can.
No, all good, all good. So let's talk about the strategies in terms of then minimizing tax. So I know I just gave that sort of very loose description. So we've talked about super. So if somebody does want to try and minimize their tax to that 130, Davey, can you talk us through sort of how some other strategies might work around that?
Yeah, so in Australia, there's 3 main ways to do it. Okay, so the first way is to reduce your profit, right? So reduce your taxable income. And how do you reduce your taxable income? That's like either you reduce your income or you increase the expenses. And then as a result, your profit drops and then you pay less tax as a result of that. The second method is you shift your income elsewhere. So if you can shift your income, for example, to your spouse or to your super fund, that's another way to try, or leave it in the company at 25%. That's another way to minimize your tax. And the last way is using concessions. So the A2 does have some sort of concessions. For example, instant asset write-off, you spend this amount, then you get a claim up front. There's a prepayment rule as well for small businesses. So for example, knowing that you're going to spend, $10,000 in software costs for next year or travel costs for next year or insurances for next year, you can actually bring that forward and claim it and spend it now and in this financial year, and you still get to claim that tax deduction. So that's using tax concessions to be able to kind of get that extra edge. Obviously, there's also other rules where I think last year they had like an energy rebate where if you spent money on equipment that, like for example, solar panels, you could get an extra 20% tax deduction. So they're kind of the 3 rules. So to go more into detail of each one, I don't want to go, I think I've got a bit more extra time on this one, but to go more in detail, tax deductions to minimize your profit is probably the way to go. So tax deductions like claiming your insurances up front, using the instant asset write-off, paying commissions or out to your referral partners. A good way of paying commissions, and I tell this to a lot of my brokers, is that instead of trying to get a tax invoice from your referral partners, some of them don't have ABNs. So buying gift cards is another way of tax deductions, because this is a way that directly relates to trying to increase your income. So the HO actually allows you to claim gift cards that you purchase from Woolies or from like the local supermarket or even online. You can actually claim that. Obviously, we've been talking about super. Putting money into super also helps you reduce your profits. The second method is shifting income. That involves you setting up a family trust that owns the business or owns the company in which the business trades in, and then distributing profits to a low income earner within your family, or distributing profits into a bucket company that has a lower tax rate than your personal tax. So they are the first two ways, and the other way is looking for concessions, which you have to speak to your accountant.
And I think the more that I've worked with the accountant space, and definitely with my accountant, I know that from a consumer perspective, I used to just equate accountants like a doctor. Like they would just issue a tax statement, and I hated receiving that. But then I sort of clocked that accountants actually save money. And then, you know, working particularly in business, working with an accountant who's really switched on, and the value that that can actually create. And then in terms of creating that, as you've probably heard me talk about, like those wealth circles. So, you know, broking, accounting, planning, and then the lender, it really ring fences that company or that client. But it also means that, say, for instance, in your perspective, Matt, you'll have a very clear understanding of where the business is at and how to then structure the loan to help those tax minimization strategies and or other. So Matt, staying with you on that point, how are you seeing business clients structure their loans to be tax efficient?
Yeah, it's a really good question. So I started off my finance career as a corporate banker, and a lot of that is, you know, big ticket items and large household names. You know, their financials were quite complex, and they used to have to try and declare as much profit as they could to distribute to shareholders and all the rest of it. But when I got into small business, I remember looking at some of the P&Ls, and the P&Ls were, you know, $600-700 profit for the year. And I couldn't get my head around, it's what Davey said earlier. I said, how do these self-employed people live like on $700 profit for the whole year? And then it all started to click into place that this is all tax efficient. There's a number of concessions in there. There's a number of line items that need further explanation. And, you know, you ring up the accountant and they'd say, look, this is where they spent their money. And a lot of their personal expenses get put through the business. And it all started to make more sense as to what happens in the self-employed and the SME sort of space. So in terms of, you know, structuring your facilities to make that happen, as I said, a lot of expenses get run through business accounts. The rent gets run through, obviously. You've got high depreciation costs, borrowing and interest on borrowings and fees and all the rest of it are all tax deductible in the right circumstance. So we do see a lot of that. But I guess when you're dealing with major lenders, the rule always used to be one or the other. You either pay tax and borrow money, or you don't borrow money and you don't pay tax, because the banks see that $700-800 profit as that's the figure we use to determine servicing. So private lending has a really good space in the SME world, in respect of we can understand the nuances of how these financials are structured. We can understand that all your expenses and the money that you actually pull out of the business is in effect disguised in that P&L and that balance sheet. And that's, I think private lending offers a very good solution for people that don't want to pay as much tax, but they also want to leverage and borrow as well.
Yeah, I think that's a really good way to look at it. And I know just again from my personal experience, until you start running your business, once you realize these little, what would be the little tricks of the trade of what is tax deductible, how to structure things, etc. It's like for me, it's like walking into a candy shop. Like once you realize what you can claim, and obviously all kosher done in conjunction with an accountant, it really rewires how you think of business. But Matt, to your point, I've often thought, well, if I did want to borrow, what does that then look like? Because to your point, like a traditional lender is going to look at, profit statements in a different capacity. So what I really take from that is, again, I would really urge the brokers who are here today to really work in very close collaboration with accountants. And I'm always a massive fan from a business perspective is meeting with an accountant. If it's not monthly, then at least quarterly, just to sort of see where your business is tracking, but also to say, look, this is where we're at, and we're in a growth period, or we are a bit challenged at the moment, and to really work out with an accountant when you're going to invest in whatever case that might be. And then to whether you're going down the private lending route or other, to sort of know who you're going to speak with at the appropriate time. So then you've really got the best of both worlds.
Yeah, I mean, we get a lot of what are called equity rich, cash poor clients where, again, they don't show a lot of profit for that very reason. And they want to cash out against that equity for working capital, for example. They would take a private lending solution for 12, 18, 24 months, pump that money into the business, and all of a sudden their P&Ls look a hell of a lot better after that cash injection and that trading period that they've been able to leverage on. And they then become bank ready, so to speak. And again, what you said in conjunction with the accountants, really, really important, that if you've all got the same strategy, and this includes the brokers as well, if everybody's on the same page around what the strategy is and what they want to do, then that 12, 24, 36 month period is really, really important to then get them into a better position. And as I said, the power of relationships is more important than ever in that respect.
Indeed. Well, moving on, Davey, we were chatting offline about the very contentious issue of payroll tax at the moment. This is universally a discussion point for brokers based on its potential widespread implications. So let's segue over to this topic. If you can chat through the situation and again, the implication of whether brokers are deemed to be operating under an aggregator in terms of being subject to paying payroll tax, without going into specifics, can you just go into where the lay of the land is and what those corresponding effects are going to look like?
Yeah, so basically, it's new. It's this new thing that's happening. It's actually been around for quite some time, and basically, the ATO and the government was really targeting the medical industry at first. So medical industry, you've had doctors that work in clinics and health practices. Medical practices. And basically, they were seeing that every doctor that was working there, even though they were contractors, they had their own clients, they will run through this practice and they were considered employees. So they wanted to charge payroll tax of 5%. So this payroll tax isn't to be confused with PAYG withholding or wages tax for an employee. It's actually on top, and it's governed by each state of Australia. So New South Wales, Queensland, Victoria, they basically said that, well, we want a share of the payroll that's getting paid, and any payroll that's been paid up to $1.2 million for New South Wales, anything above that, we're going to charge 5%, and we're going to charge it onto the payroll employer that's paying the payroll for all the employees. So the problem is, as now they're trying to target aggregators, aggregators seen as employers for certain mortgage brokers that are working under that brand name, and that's what they're looking for. So if you are running a business, you have your own brand as a broker, you have employees, or you have contractors that are working or admin working under your business, then you probably don't need to be worried about it. But if you work under that brand you don't really have any employees and you're basically using their name and you're kind of seen as an employee, that's when there's going to be 5% imposed. However, that 5% is not imposed to you as a broker, it's imposed to the aggregator. So the impact on that is the aggregators may push that cost over to the brokers and it may just increase the admin costs. So that's what's happening. It only just, there was this really large court case that just kind of came to fruition. Now, I think that it's still going to go for the next 6 to 12 months because it's probably going to be an appeal. So let's just wait and see what happens. But just be careful. If you want to kind of try to avoid this, then it's better to be seen as a business. And that means that you either run under a different brand or your own brand, or you start having employees under your business. And that most likely will protect you, that you don't have to deal with the extra 5% that might be pushed onto you by aggregators. So that's the main thing that's happening. I don't want to go into much specifics because it's still very new and things might get overthrown after the appeal.
Yeah, loan market, I think they were involved, weren't they? I think they had a big payroll tax case.
Yeah, it's still happening though. So, and I'm sure there's more cases that would happen. And yeah. I hate payroll tax. It's probably the most hated tax by accountants, because why would you impose payroll tax on, like, payroll is important for Australia, or we're going to just outsource all our payroll. Like, that's not anyone that wants to, like, no one wants that to happen, where we just don't want to have employees in Australia. So why do we even have payroll tax in the first place? It doesn't make any sense.
Yeah, indeed. Well, we're going quite well with time, and I love how many questions are coming through. So feel free to continue to shoot them through in either the chat function or Q&A function. So we might just segue for a moment. Davey, the gift card concept has been received extremely well, and in terms of a potential little loophole. So we've got a few questions come through around that. So we have from Greg Tish, how many gift cards can be purchased, and is there a limit on the gift card amount?
Unfortunately, there isn't no limit on this because it's kind of seen as advertising. Like, you're trying to buy a gift card to promote your business so they can refer you more work. So it's directly related to income. Obviously, if you spend too much on gift cards, it may raise an eyebrow with the ATO. They may look into it, but if you can correctly prove that this gift card was given to that referral partner, and the reason being is because they referred you a deal that, you know, you end up making 20 grand on it, you know, the sky's the limit with that gift card. However, obviously, it does get looked at if it comes into an audit with the ATO. However, it's claimable. It is, and I've seen it happen many times with our clients. Obviously, if you want to ensure that it kind of makes sense, gift cards are usually purchased once a referral partner has referred you a client, and obviously during times of like Christmas, for example, when you know, it's a time of giving gifts to your referral partners. That's a good time to buy gift cards as well.
So perhaps don't buy a $300 Woolworths gift card each week.
Yes, that makes sense.
Okay, we have a question that's coming from William. If you leave profit in the company, how do you get it out to make use of it?
That's a good question. I guess, why are you getting it out is the question I'm going to ask you. When I ask the client this, they usually say, I want to invest it. So then I ask them, well, why can't you first invest in your company? Because there's a 25% tax rate in your company. Or two, do you want to distribute it over to a bucket company instead and invest using the bucket company? Or do you want to move it into the super fund where you can then invest using the super fund, self-managed super fund at 15%? So that's the first question you got to ask yourself. If you're planning to use it for personal use, then there's really the only way that you can use it for personal use and lower your tax rate is to find low income individuals within the family, and having a family trust own the business or the shares in the trading company. Then you can kind of distribute the profits using the family trust. That kind of creates some flexibility. So if you're operating under a company that's 100% owned by you, or a business that's 100% run by you and owned by you, then you need to restructure your structure, restructure your entity to fix that problem. hopefully that answers that question.
Thank you. So Matt, one for you. An anonymous attendee has asked the question, what is the benefit of buying a commercial property under an SMSF?
Yeah, I mean, there's obviously the tax benefits that we've spoken extensively about today as well. I also think that purchasing a commercial property under your super gives you a real tangible feel on your investment. I don't have a self-managed super, and checking in to see how your super's performing every couple of weeks. It's not taxing, but it's, you sort of think to yourself, well, where exactly is this going? What sort of strategy are these guys looking at? And trying to figure out where all that money's going, it can be a little challenging. So if you've got the bricks and mortar that you're in every day and you're paying yourself the rent, SMSF audits come round, I think Davey might be able to correct me, I think every 12 to 24 months, where you sometimes need a property valuation and things like that. So you get a real tangible feel on what your investment's worth and how it's performing and how you're looking after it. And that for me it very much ticks all the boxes for looking to invest in your super.
I think you raise a really good point, and I think it really taps into, that great Australian dream. We love bricks and mortar, we love something tangible, and we're obsessed with property. So I sort of see that natural evolution also really coinciding with business owners becoming much more astute about their finances. One thing that I really observed from my end is post-COVID or in COVID, businesses that may have just, been blinkered, may not have had, all of their expenses on the radar, et cetera, COVID really shook that landscape up. And again, Davey, you could probably talk to this as well. I know, being a business owner myself, before COVID, I had a fairly loose overview of where everything was at and so on and so forth. In COVID, it was like, right, strip down on all fat, reshape, reinvest, et cetera. So my observation post this COVID shake-up is business owners, it's done business owners as a favor because it's made us much more astute about our finances. It's forced us to be much more financially literate in terms of the full financial landscape as it relates to concessions or this or that or the other. And it's really bridged the world with accountants to really guide us in that process. So my observation from an SMSF perspective is there's going to be a natural consequence. If you're more astute as a business owner and you're more receptive to other types of lending, income, structures, and so forth, it doesn't take long to connect the dots. Is there a better way for me to do this? Is there a more secure way for me to do this, either from an investment perspective or a psychological perspective, to then consider SMSF as the bricks and mortar that I sit in because it is in my control. It's not in global markets control, et cetera. So Davey, have you seen sort of the evolution of business owners change in that post-COVID shake-up?
Yeah, it's not even just business owners, and it's actually individuals all over Australia. And the reason being is because I actually wrote an article about this a few days ago, and I basically said that the reason why there's a lot of change and push to investing in property is because that back then, like for the last several years, you're getting a 3 to 6% interest income in your bank if you were to leave money in the bank. However, inflation, and everyone knows, bumped up all the way to 7%, 8%. And that's where you're actually losing money if you're just leaving money in the bank. That's what was happening. And people just realized that. People should have known that ages ago. It was a thing. Everyone talks about it, but people just kind of realized, holy crap, I'm actually losing a lot of money. And so if they left it in the super fund, same thing was happening. You're getting an 8% return. However, inflation was 8%. So you basically didn't make any money. Some super funds were actually losing money. And we saw the Royal Commission happen with investments and investment funds, and super funds were also impacted by it as well. The growth of the investments, and so people now have just realized that, wow, we really got to put a hands-on approach when it comes to our investments. And where did they turn to? They turn to an asset class that has made 7 to 15% in returns per year on average. 7 to 15% return on average. So they turn to that class, and that class is property. And they realize that property also, and I'm not giving financial advice, I'm just giving straight numbers and information, is that they can use leverage too. So they can actually double or triple their returns by just using leverage. And obviously the interest rate was very low at one point. And to some clients, they also still state that the interest rate is quite low because they've been around for like, some of my clients are like, 60, 70 years old. And they say, Davey, interest rate's still low. We used to be dealing with interest rates at 15, 20%. It's still very low. And so it's actually still a very good time. And that's why I think the change has happened, that people are starting to realize that they can't just rely on institutions or funds anymore. They got to take the matter in their own hands and invest in a class, asset class that actually makes a lot more returns and is actually considered safer. Yeah.
Thank you. We've had another question come in saying, can you transfer your commercial property under an individual name to an SMSF after 60 years of age?
After 6 years of age? Or after 60 years
60.
of age? Oh, yeah. Commercial property. Yes, you can transfer a commercial property anytime into your SMSF. It doesn't have to be over 60. I don't know why you would wait till over 60. You most likely would do it as soon as possible, because if you wait till over 60, then the value of the property would have gone up significantly. And as a result, then you're going to have to pay capital gains tax on that property. You'll want to transfer as quick as possible into the SMSF and keep the cost base quite low. So if you want to sell it one day in the future or earn income from rental income, then the tax is either 0% or 15% for your commercial property. Also, you could, if the property is owned in your name and it's actually used to run a business, you have small business CGT concessions to even minimize the tax even more. So you should jump on it as quick as possible, because if you don't use it, you may not be eligible later on down the track, because there are specific rules that you have to meet and requirements. And the more older you get, most likely the more high income you make, as well as your assets might increase, and that pushes you out of the eligibility requirements. So if you earn over $2 million in turnover, or if you're under 6 million, over 6 million net assets, you can't get those concessions anymore. So it's actually better for you to move as quick as possible to push the commercial asset into a SMSF. Again, not financial advice, just giving you information. Thank
you. So Matt, a question for you. Not sure whether it's going to be in your wheelhouse, but I'll run it by you. A question from Stuart. Are there any special requirements for lending in SMSF for farmland?
That's a very good question, sure. Yeah, in terms of the primary production piece, the agriculture piece, you've obviously got the Farm Debt Mediation Act, which a lot of lenders are particularly frightened of. I'm not overly sure on what the Swift rules are in regards to agriculture. So yeah, I'd hate to give you the wrong answer there, but from Aquamore using them as a lender, our perspective is that we don't lend to farms or agriculture or primary production due to the, as I mentioned earlier, the Farm Debt Mediation Act being one, and secondly, we just don't understand it. And the age-old rule is, if you don't understand something, don't invest in it, or don't lend to them. So unfortunately, it's not something I'd be able to answer. But look, I could do a little bit of research and come back to you guys.
It's actually very complicated, so complicated, and that's why the perfect answer is, it's too complex. Most banks won't lend because it's too complex. Even myself, I won't deal with it, and the reason being is because the rules are just so complex. You're not actually supposed to be able to buy a property that you live in in an SMSF, and because it's a farmland, they can kind of get away around it, but it's so complex that you could stuff it up, and then it will cause you a lot more taxes, and that's why most lenders don't get involved as well. That's what I think.
I mean,
it is very complex.
Even changing the zoning on a property, you can change the zoning to RU1 primary production if you've got a couple of olive trees on your house, which I know some people have done. They've put a couple of olive trees in the driveway so that should they default on the loan, they can turn around and say, well, it's now primary production, it's owned RU1, and we can get relief from the Farm Debt Mediation Act. And there are ways around it. As you said, it's just incredibly complex, especially when you've got superannuation involved.
So sticking to super, which is what a lot of people are interested in, we've had a question come in from Megan asking, can I sell my house to my SMSF?
Short answer is no.
No.
Can't do it. Yeah, because you can't you can't have a property that's in-house asset, and you can't sell to a related party. Is that a home that they're talking about, or is it a commercial property?
It appears residential.
Yeah, if it's a commercial property, it's possible. Even though you're using it for your business. However, if it's a home, you can't. You can't even sell. You can't even rent it out to a related party as well. So if like you got an aunt or a cousin or a brother or sister that wants to rent it, if it's a residential property, you can't even rent it out. So there's a lot of strict rules when it comes to your home or a related party that you're wanting to get involved with the SMSF. So just to ensure you guys don't get confused, you can own residential property in a SMSF, but it just can't be related to a family member in any way. So like you can't live in it, you can't rent it out or anything like that.
Yeah, they've definitely thought of everything. There are no loopholes.
Well, I think people found loopholes before and they got away with it, and so they're now trying to.
I wish I was part of that initial cohort.
Yeah.
So we've just also had Christopher, who's an SMSF auditor, make a good point that there are ongoing compliance costs with an SMSF, and that each year there does need to be evaluation that's done, and the ATO are actively engaged where funds show no movement in value year on year. So thank you for that input. But we will have to wrap shortly, and I did want to do that in terms of what tips that you would have for the brokers listening today. So Davey, what are your top tips for brokers in this space?
To minimize tax or just to run a business specifically?
I would just say business tips.
Okay, sounds good. Well, most of my brokers, when they meet up with me, I always ask them to kind of set a goal for the year. And you'll be surprised how many people just don't set goals, especially brokers. Probably the reason being is because it's very hard for them to kind of tell how much money they're going to make in terms of loans and how many leads they come in. They act with referral partners and referrals from existing clients. But I still try to get them to kind of put a number on it. And putting a number on it doesn't mean that it can't be changed. And also, it also is good for you so you can actually kind of work on a goal. And it's very easy. So for example, let's just say that you want to make $150,000 a year in commissions. That's upfront plus, trail. And let's just work on upfront comms. Just say that average, deal is 0.7% in upfront comms. That means that you need to aim for about $25 million in loans that you need to write. Divide that by 12 for 12 months. You're looking at settling about $2 million in loans per month, right? How many leads do you need to be able to settle $2 million? And you won't know for a fact if you just started your business and you started in brokering, but over time, you can look at your previous data. So you need to kind of start setting numbers up. Also look at your previous data on how many leads, how many people did you speak to in the previous months that got you $2 million in loans written, settled. Yeah. And then over time, you're going to get a better understanding of your numbers, and then you can set better goals that are more accurate. But if you don't start now, your numbers are never going to be accurate, and you're never going to be able to figure out, how to get to that, 150K in comms in a year, or maybe even 500K in comms a year.
Thank you.
Yeah. So that's one thing.
Okay, so we're going to have to flip to Matt because we've only got 30 seconds left.
Oh, yeah.
So Matt, what are your 30 seconds top tips, maximize the year ahead for brokers?
Yeah, look, piggyback on Davey's point, reverse engineer the numbers, right? How many conversations have you had that's going to lead to scenarios, it's going to lead to submissions, it's going to lead to X, Y, and Z. Power of relationships, always very strong. That involves both, lenders and your clients. relationships, understanding your client's position, understanding where they fit in the market, and just keeping all of that in mind is probably the strategy I would recommend. So.
Well, thank you so much to you both. We could talk for so much longer, but I am conscious of everyone's schedule. So thank you everyone for joining us today. We will be in touch with Matt and Davey's details as well as those XMSF assets. So thanks for tuning in, and I look forward to seeing you next time.
Thanks, Ash. Thanks, Davey. Thanks,
You
everyone.
guys, thanks.